Property prices are still climbing despite the recent lockdowns. So is it too late to buy? If you watched one of my previous videos regarding the dip in house price during the lockdown seen all around Australia last year, you'll probably be asking, why hasn't this happened this time around? There's a combination of different factors involved, and today we are going to explore them. Hi, I'm the Fungible Millennial. I do videos on all things finance, including cryptocurrency, NFTs, share market, and of course, property investing. If you're new to my channel, I would really love it if you could like this video and subscribe to my channel for updates. If you remember from my last property market update video, I showed this graph that demonstrated a dip in the residential house price around May last year. This happened soon after the crash of the stock market in March. Most states started recovering around November and the residential house price bounced back. However, there was doom and gloom in the air as we weren't sure what would happen to the residential property market when the fiscal support, JobKeeper, expires. Firstly, the end of JobKeeper dampened the market just a little bit. In fact, data from CoreLogic saw an increase of 1.6% in national house price in the month of July, which is an annual increase of 16.1%. Breaking this down further, houses have increased in value by 18.4% nationwide, whilst units have increased by 8.7%. However, the rate at which home prices have increased has slowed down since March this year. The reason for this is affordability. The increase in house price is so ridiculous that it's just not proportional to the increase in people's wages. And more people are either holding off until a dip happens or they have simply given up. The home price is still increasing though, and this is increasing at a rate that is well above average. The main reason for this is that supply is falling, but demand is still relatively high. This is contributed by the fact that interest rates are still very low, and it isn't likely that these rates will change anytime soon. If you refer back to my old videos, the RBA has repeatedly stated that the rates will only rise if there's a strong recovery of the labour market and an increase in inflation to 2 to 3%. And this isn't expected to occur until 2024. Banks are already increasing their long-term interest rates in anticipation. Furthermore, in June this year, the RBA ended the deal with the banks to borrow money at 0.1% for 3 years. On top of this, the RBA has promised to keep the 3-year government bond yield at 0.1%. For now, the super low interest rates of around 2% for homeowners are very tantalizing and great time to borrow and buy a home. Major banks are reporting an increase in borrowing, locking in cheap fixed rates in anticipation that there will be an interest hike soon. Despite the extremely high number of cases and hard lockdown seen around Australia, buyers are comfortable with online auctions and consumer sentiments continue to be high and positive when it comes to housing market. This cannot said to be the same when we went through a hard lockdown a year ago, when we saw a momentary drop in the housing price. The consumer sentiments are high because this lockdown is very different to the last one. Even though we're dealing with high numbers of infection and a more transmissible virus variant, a year ago we had no approved vaccine. And there was a cloud of uncertainty of where the market was heading because most people never faced a pandemic. There are some experts that believe this consumer sentiment could be short-lived. Lewis Christopher from SQM Research said that there has been a fall in asking price in Sydney for several weeks in a row. And there are signs of the tightening of regulations by banks. Lewis also believes that if the lockdowns were to be prolonged till December, we might see a weakening of that local housing market as a side effect of the contraction of the local economy. We are already seeing a slowdown of first home buyers as affordability decreases. Banks have reported a decrease in lending to first home owners 3 months in a row. But in place of the first home owners, there is an increase in investors on the market, with an increase in lending to this group from 23 to 26%, which is the highest since 2017, when we saw a property boom. However, this is still below the average of 35%. For months, we have been speculating about the tightening of regulations by APRA, but this might actually come into fruition once we see a huge shift in the types of buyers coming onto the market. Currently, owner-occupiers are still the main drivers of the market, and for this reason, banks are reluctant to impose restrictions. However, if there is a drastic shift in lending by investors followed by an increase in house price, regulators could step in. The main reason for this is due to the fact that speculative demands caused by investors trying to take advantage of the potential capital gains, it amplifies the acceleration in price. This is almost an artificial amplification. So the artificial amplification in price increases the risk of huge price falls. A drastic fall is bad for the economy. In the past, the RBA has said that they would not want this to happen. In an event, if the investors do take the majority stake in the housing market, regulators will likely intervene to restrict borrowing by investors. Now let's circle back to whether it's too late to buy. Please don't take this as financial advice because I am not a financial advisor and I do this for entertainment purposes. And always make sure you do your due diligence before you purchase any property. Let's look at the worst case scenario. RBA has held the 0.1% on interest for a while now. If the rates do go up in 2024, we could potentially see an increase in people who cannot repay their home loan and thereby selling their homes or default on their loan. This means we could potentially see a spike in homes being listed on the market. As the supply goes up, combined with the high interest rate and a lack of people willing to buy because the rates are too high, property become cheaper, further exacerbating the situation of decrease in home prices. This, of course, creates negative equity, meaning your home loan is larger than what it's really worth. This type of market normally favors the buyer, as there are more choices for the buyer to pick from. This is the complete opposite of the situation we are in now, whereby we have low supply and low interest rate, which favors the seller, and hence it is a seller's market. If you were to purchase a house right now, you need to do your maths. If the property you want to purchase tumbles, let's say by 20%, would you have enough cash reserve to cover that fall? For an owner-occupier with a large loan, low rates right now means that you probably have an affordable repayment. However, if the rates go up, let's say by double to 3 or 4%, you need to calculate whether you can afford to pay back on the loan. A good way to shield yourself from an interest rate hike is to repay as much loan as you can right now. So in a likely chance of a down market, your loan is not in negative equity. It will give you a chance to ride out the down cycle. You should also think about locking in your interest rates. There are so many lenders giving out low fixed interest rates right now. It would be wise to consider shopping around and locking in the rates so you are temporarily shielded from any interest rate hike. So would I invest? For an investor like myself, I would buy into the market if a great opportunity came along and the numbers stack up. I always look for capital growth as well as rental yield. The interest rates that I pay right now is at least 1 to 2% higher than most owner-occupier loans. and I managed to hold onto my properties because the numbers stack up. And on top of this, I have enough cash reserve to cover these repayments when the interest rates go up even further. My property portfolio is spread across the whole of Australia. If there was a crash, my risk is spread across multiple properties. Furthermore, if the house price does take a tumble, I'm not in a position where I have negative equity because my properties have increased by at least 40%. In my humble opinion, and now that's my opinion, and you might disagree with me, there is still a ton of space for capital growth left in the market. This will definitely benefit if you are buying for a short-term flip or hold it for the long run. And finally, don't act on your impulse and don't overstretch your loan. Anyway, I hope you enjoyed this video. I'm the Fungible Millennial. See you next time.